The latest U.S. job numbers are in. What do they mean for the Federal Reserve and interest rates? I'm Lisa Bernhard with Reuters, and joining me today is Melissa Brown of Simcorp. Melissa, today we got the Labor Department's jobs report for June. The economy added more jobs than expected, but the unemployment rate also ticked up to 4.1%. What do you make of the numbers?
Interesting reading, the various comments that pundits are making. They run the spectrum from this is great to this is terrible. So, I think it probably comes down, right in the middle on average that, the employment number was good. Unemployment has ticked up a little bit. Maybe saying that this soft landing scenario that we've been talking about for a very long time is maybe the likelihood of that has increased. Interestingly, we think that that's actually potentially the best scenario. If you look at no landing, soft landing, hard landing, the soft landing scenario does give you slightly lower interest rates without having a huge impact on earnings. And so that is, from our work, one of the best scenarios that we can think of.
Markets are largely pricing in a more than 70% chance that the Federal Reserve will begin cutting rates in September. Does that still remain a little bit too optimistic? Do we still need more months of data? What do you think?
Well, I guess the good news is we will get more months of data between now and September. And I think assuming that we continue on the same path, which is this look of a soft landing, then we might see a rate cut. I think that, seems like a good option. We always, and we've been talking about this for months, have the issue of the Fed not wanting to appear to be too political. And that, I suppose, in the absence of firm data, could sway their decision to not do anything as opposed to do something. But, Xing that out, I think, markets typically are pretty good at predicting these things. So that does look like a reasonable scenario.
All right. Well, speaking of things getting political, let's turn now to the presidential election, because we had Biden turn in what was pretty much accepted as a shaky performance in the debate, and now talks of potentially replacing him. We had a Supreme Court decision on presidential immunity that could potentially help President Trump in his legal battles going forward. And tonight we have an interview with Biden on ABC. So markets can largely shrug off elections, have in the past. But do you think actually that investors will be watching closely tonight? And I know we're going into a weekend, but could this potentially be a market moving interview in terms of how investors position themselves going forward?
Well, I think there is such a stark contrast between the policies of the two candidates that if investors are watching and, whichever way it sways them, it really could have an impact on their view of how to invest their money for the next, say, 6 to 12 months. If Biden is to stay in office, probably the policies that are in place now will continue. There won't be a huge change in, overall policy. If Trump wins, then, he's announced what he said his policies are going to be are very, very different from what we're seeing now. And things, whether it's, lower taxes or higher tariffs or less regulation, all of those things have the potential to impact either the broad market or individual sectors.
Some media outlets are already starting to write pieces about a possible Trump presidency. And we had a piece at Reuters today that talked about the bond market and how the 10-year Treasury rose after that debate, which would indicate that rates would stay higher for longer and therefore inflation would be higher. Explain why that would be and whether you agree with that.
I agree that rates would be higher. I'm not sure of the, which causes which. I think the idea of putting heavy tariffs on a number of industries is very inflationary. And that could in turn lead to higher rates as opposed to the other way around. I think there are other measures, tax cuts, if they don't result in higher growth and more revenues coming in anyway. Increasing the deficit can also increase rates. So, I think, again, based on the policies that have been, put in place, I think there is the potential for rates, for long end rates to stay higher longer.